Question 1. Policy premiums and calculations. Which of the following factors does not directly impact the premium calculation for a Missouri term life insurance policy? A. The insured smoking status. B. The length of the term policy. C. The number of beneficiaries named in the policy. D. The insured's health condition. Answer: C. The number of beneficiaries named in the policy. Explanation: the premium for a term life insurance policy is primarily determined by factors such as the insured's age, health, smoking status, and the term length of the policy. The number of beneficiaries does not affect the premium. The insurer bases the premium on the likelihood of having to pay out the death benefit, which is influenced by the insured's health and lifestyle factors, as well as the length of time the coverage is in force. Term length. The Missouri Department of Insurance emphasizes that insurers must apply these underwriting criteria fairly and consistently according to state regulations. Question 2. Missouri state insurance laws and regulations. Scenario-based. Sarah, a licensed life insurance producer in Missouri, is approached by a client, Mr. Turner, who wishes to replace his current term life insurance policy with a new one. Mr. Turner was not entirely happy with the explanations his previous agent gave him about his current policy. Sarah reviews the policy and finds that Mr. Turner might benefit from the replacement due to lower premiums. However, she realizes that Mr. Turner has not yet been informed about certain important aspects of the replacement process. What must Sarah do in compliance with Missouri law before proceeding with the replacement of Mr. Turner's policy? They notify the original insurer within 10 days of the replacement. B. Have Mr. Turner sign a disclosure form outlining the disadvantages of policy replacement. C. Inform Mr. Turner that the free look period does not apply to the new policy. D. Ensure that Mr. Turner has completed a medical exam before the new policy can be issued. Answer: B. Have Mr. Turner sign a disclosure form outlining the disadvantages of policy replacement. Explanation: according to Missouri law regarding the replacement of life insurance policies, producers are required to provide a disclosure to the client outlining the potential disadvantages of replacing an existing policy with a new one. This is designed to protect consumers from twisting and other unethical practices where agents may encourage clients to switch policies without full disclosure. Producers are also required to notify the insurer of the replacement, but the disclosure to the client is a critical step that must happen first per Missouri's policy replacement rules. Question 3. Policy riders and provisions. A term life insurance policy includes a waiver of premium rider. Under which of the following circumstances will the waiver of premium rider typically not apply? A. The insured becomes totally disabled due to illness. B. The insured is temporarily laid off from their job. C. The insured becomes disabled due to an accident. D. The insured is permanently disabled and unable to work. Answer: B. The insured is temporarily laid off from their job. Explanation: a waiver of premium rider allows the policyholder to stop paying premiums if they become totally disabled due to illness or injury and are unable to work. However, a temporary job loss, such as being laid off, does not qualify for this benefit, as the rider specifically applies to disabilities, not employment status. This rider protects insured individuals who can no longer generate income due to disability, ensuring their coverage continues without payment of premiums. Missouri's regulations require clear disclosure of the conditions under which this rider can be used, ensuring that policyholders fully understand their options. Question 4. Beneficiaries. In a Missouri term life insurance policy, if both the insured and the primary beneficiary die in a common disaster and the policy contains a common disaster cause, what typically happens to the death benefit? A. The death benefit is paid to the estate of the primary beneficiary. B. The death benefit is paid to the estate of the insured. C. The death benefit is paid to the contingent beneficiary. D. The death benefit is forfeited. Answer: C. The death benefit is paid to the contingent beneficiary. Explanation: a common disaster clause ensures that if the primary beneficiary dies at the same time as the insured or shortly thereafter, the death benefit will be paid to the contingent beneficiary rather than the estate of the primary beneficiary. The goal of this provision is to prevent the need for probate proceedings and ensure that the policy proceeds go to a designated second beneficiary. Missouri's insurance regulations generally require that such provisions be clearly explained to policyholders and beneficiaries at the time of policy issuance. Question 5. Underwriting process. Which of the following does not describe a typical classification for life insurance risk in the underwriting process? A. Preferred. B. Substandard. C. Guaranteed. D. Decline. Answer: C. Guaranteed. Explanation: in the life insurance underwriting process, individuals are classified into different risk categories based on their health, lifestyle, and other factors. These categories typically include preferred for the healthiest individuals, standard for those with average risk, substandard for high risk individuals, and decline for those deemed uninsurable. Guaranteed is not a risk classification in this context. However, some policies, such as guaranteed issue policies, may be offered without medical underwriting, but this is separate from traditional risk classifications. Missouri's underwriting rules require that insurers use these classifications to set premiums and determine coverage. Answer: B. The potential increase in premiums for the permanent policy. Explanation: when converting from a term policy to a permanent policy under the conversion privilege, the premium for the permanent policy will typically be significantly higher due to the lifetime coverage and cash value component. Mr. Roberts will not be required to undergo medical underwriting again, which is advantageous given his health issues, but the increase in premiums is a key consideration. Missouri's regulations require insurers to clearly communicate the costs and benefits associated with policy conversion to ensure that policyholders can make informed decisions. Question 6. Conversion privilege and requirements, scenario-based. Mr. Roberts has a 20-year term life insurance policy in Missouri that is approaching its 15th year. He is concerned that he may not qualify for another policy due to his recent health issues. His policy contains a conversion privilege that allows him to convert his term policy into a permanent policy without undergoing medical underwriting. What is the most important factor Mr. Roberts should consider when deciding whether to convert his policy? A. The age at which he can convert the policy. B. The potential increase in premiums for the permanent policy. C. The new death benefit amount after conversion. D. The ability to add new riders to the converted policy. Question 7. Types of life insurance policies. Which of the following describes the main difference between a renewable term life insurance policy and a non-renewable term life insurance policy? A. Renewable term allows the policyholder to renew the policy at a higher premium without proof of insurability, while non-renewable term requires new underwriting for renewal. B. Renewable term automatically extends coverage for the same premium, while non-renewable term cancels coverage after the term expires. C. Renewable term allows for a lump sum payout at the end of the term, while non-renewable term does not. D. Renewable term policies convert to whole life policies, while non-renewable term policies expire without coverage. Answer: A renewable term allows the policyholder to renew the policy at a higher premium without proof of insurability, while non-renewable term requires new underwriting for renewal. Explanation: a renewable term life insurance policy allows the policyholder to renew their policy for an additional term without the need to undergo medical underwriting, though the premiums will increase with age. In contrast, a non-renewable term policy would require new underwriting to continue coverage, and if the policyholder's health has worsened, they may not qualify. Missouri's regulations stipulate that renewable terms provide policyholders with greater flexibility, especially as they age or experience health issues. Question 8. Claims and settlement options. If a Missouri term life insurance policyholder dies and the death benefit is paid out in a fixed period settlement option, what does this mean? A. The death benefit is paid out in equal installments over a predetermined number of years. B. The death benefit is paid in one lump sum immediately after the insured's death. C. The death benefit is used to purchase a lifetime annuity for the beneficiary. D. The death benefit is paid only if the insured lives beyond the policy term. Answer: A. The death benefit is paid out in equal installments over a predetermined number of years. Explanation: in the fixed period settlement option, the insurer pays the death benefit in equal installments over a set number of years, rather than as a lump sum. This option allows beneficiaries to receive income over time, which may be preferable for budgeting and financial planning. Missouri law requires life insurers to offer various settlement options and ensures that beneficiaries are fully informed of their choices before receiving payment. Question 9. Policy riders and provisions. Which of the following riders would most likely increase the premium of a Missouri term life insurance policy? A. Waiver of premium rider. B. Misstatement of age provision. C. Grace period extension rider. D. Free look rider. Answer: A. Waiver of premium rider. Explanation: a waiver of premium rider allows the policyholder to stop paying premiums if they become totally disabled, making it a valuable addition, but one that increases the policy's cost. Riders that provide additional benefits, such as waiving premiums under specific circumstances, generally increase the premium. Provisions like the grace period or free look period are typically built into policies by law and do not carry additional costs. Missouri's insurance regulations allow insurers to charge extra for optional riders that enhance the policyholder's protection. Question 10. Reinsurance and retention limits. Reinsurance is most commonly used by insurance companies to A. Increase their underwriting profits, B. Spread the risk of high claims over multiple insurers, C. Avoid paying out claims, D. Cancel high-risk policies without penalty. Answer: B. Spread the risk of high claims over multiple insurers. Explanation: reinsurance allows an insurance company to transfer part of its risk to another insurer, helping to manage large or unexpected claims. This is especially useful for policies with large face amounts or for insurers with multiple high-risk policyholders. Reinsurance helps ensure that a single claim will not devastate an insurer's financial stability. Missouri's regulations require transparency in the use of reinsurance to ensure that claims are paid appropriately and policyholders are not left without coverage due to risk management strategies. Question 11. Term life insurance policies. What is a key feature of decreasing term life insurance? A. The premium increases as the death benefit decreases over time. B. The death benefit remains level, but premiums increase. C. The death benefit decreases over time while the premium remains level. D. Both the premium and death benefit decrease over time. Answer: C. The death benefit decreases over time while the premium remains level. Explanation: in a decreasing term life insurance policy, the death benefit decreases over time, typically in alignment with a mortgage or loan repayment schedule, while the premiums remain constant throughout the policy term. This is useful for individuals who want life insurance coverage that correlates with a declining financial obligation. Missouri's insurance regulations allow insurers to offer these policies as a cost-effective option for covering specific debts that diminish over time, such as mortgages or business loans. Question 12. Types of beneficiaries. Which of the following best describes the difference between a revocable and an irrevocable beneficiary? A. An irrevocable beneficiary cannot be changed without their consent, while a revocable beneficiary can be changed by the policyholder at any time. B. An irrevocable beneficiary can be changed at any time, while a revocable beneficiary cannot. C. A revocable beneficiary receives a larger death benefit than an irrevocable beneficiary. D. A revocable beneficiary is automatically removed if the policyholder dies in a common disaster. Answer A. An irrevocable beneficiary cannot be changed without their consent, while a revocable beneficiary can be changed by the policyholder at any time. Explanation: a revocable beneficiary can be changed by the policyholder at any time without notifying or receiving permission from the beneficiary. An irrevocable beneficiary, however, cannot be removed or altered without their written consent, which gives them more security in their position. Missouri's insurance laws require that policyholders clearly designate whether beneficiaries are revocable or irrevocable, and this choice can impact legal and financial decisions such as estate planning. Question 13. Policy premiums and calculations. Which of the following factors most affects the premiums for a Missouri term life insurance policy? A. The insured's occupation. B. The insurer's investment portfolio. C. The insured's age, gender, and health. D. The insured's state of residence. Answer: C. The insured's age, gender, and health. Explanation: the primary factors that affect the cost of term life insurance premiums are the insured's age, gender, and health. Younger, healthier individuals typically pay lower premiums because they present a lower risk to the insurer. Gender also plays a role, as statistics show different mortality rates between men and women. Missouri's insurance laws ensure that premiums are based on actuarial data and underwriting principles, with protections in place to prevent unfair discrimination in rates. Question 14. Underwriting process scenario-based MS. Anderson applies for a term life insurance policy in Missouri, and during the underwriting process it is discovered that she has a pre-existing medical condition. The insurer classifies her as substandard. Of which of the following is the most likely outcome? A. MS. Anderson will automatically be denied coverage. B. MS. Anderson will be approved, but at a higher premium than standard policies. C. MS. Anderson will be approved with a waiver of premium rider. D. MS. Anderson will be approved, but the death benefit will decrease each year. Answer: BMS. Anderson will be approved but at a higher premium than standard policies. Explanation: a substandard classification means that the insurer considers the applicant to be a higher than average risk due to health or lifestyle factors, but they are still insurable. In such cases, insurers will typically offer coverage but at a higher premium to compensate for the increased risk. Missouri insurance regulations require that risk classifications be based on objective underwriting criteria and ensure transparency in the premium setting process. Question 15. Reinstatement provision. Under Missouri law, if a term life insurance policy lapses due to non-payment, how long does the policyholder typically have to reinstate the policy? A. 10 days. B. 30 days. C. 2 years. D. 5 years. Answer: C. 2 years. Explanation: most life insurance policies, including term life policies in Missouri, include a reinstatement provision that allows the policyholder to reinstate the policy within a specific time frame after it has lapsed due to non-payment, usually up to 2 years. To reinstate the policyholder must pay back all missed premiums and may have to provide evidence of insurability. This provision ensures that policyholders have an opportunity to maintain their coverage even if they face temporary financial difficulties. Question 16. Policy riders and provisions. Which of the following riders allows the insured to receive a portion of their death benefit early if diagnosed with a terminal illness? A. Waiver of premium rider. B. Accidental death benefit rider. C. Accelerated death benefit rider. D. Return of premium rider. Answer: C. Accelerated death benefit rider. Explanation: the accelerated death benefit rider allows the insured to access a portion of the policy's death benefit while they are still alive if diagnosed with a terminal illness. This can help cover medical expenses or other costs related to their condition. Missouri regulations ensure that this rider is offered on term life insurance policies as an optional benefit to policyholders, and the payout is deducted from the final death benefit paid to beneficiaries. Question 17. Insurance regulation and state versus federal authority. Which of the following best describes the role of the Missouri Department of Insurance in regulating life insurance policies? A. The Missouri Department of Insurance sets federal insurance standards. B. The Missouri Department of Insurance oversees and regulates insurance policies, licensing of agents, and consumer protections. C. The Missouri Department of Insurance determines the premium rates for all policies in the state. D. The Missouri Department of Insurance approves every individual life insurance claim before it is paid. Answer: B. The Missouri Department of Insurance oversees and regulates insurance policies, licensing of agents, and consumer protections. Explanation: the Missouri Department of Insurance is responsible for regulating the insurance industry within the state, including overseeing the licensing of agents, monitoring policy forms, ensuring that companies follow state laws, and protecting consumer rights. While insurance is regulated at the state level, federal guidelines may apply in certain situations, such as the taxation of benefits. Missouri law mandates that the department ensures that policies sold in the state meet state standards for consumer protection and financial stability. Question 18. Term life insurance policies. What is the primary advantage of a convertible term life insurance policy? A. It allows the policyholder to renew the policy without medical underwriting. B. It allows the policyholder to convert the term policy to a permanent policy without medical underwriting. C. It guarantees the death benefit will double after a set number of years. D. It automatically renews at the same premium each year. Answer: B. It allows the policyholder to convert the term policy to a permanent policy without medical underwriting. Explanation: the convertible term life insurance policy allows the policyholder to convert their term policy into a permanent policy, such as whole life insurance, without needing to undergo medical underwriting. This is a significant advantage for individuals who may develop health conditions later in life that would make obtaining new coverage difficult or expensive. Missouri law requires insurers to clearly disclose the terms of conversion, including any deadlines or restrictions, at the time of policy issuance. Question 19. Indemnity principle and subrogation. Which of the following best describes the principle of indemnity in life insurance? A. The policyholder can only recover the exact amount of financial loss suffered. B. The beneficiary can recover the death benefit even if the policyholder is not financially impacted. C. The insurer can recover from third parties any claims paid to the insured. D. The policyholder can recover more than the face value of the policy. Answer: B. The beneficiary can recover the death benefit even if the policyholder is not financially impacted. Explanation. In life insurance, the principle of indemnity is not applied in the same way as in property or casualty insurance because the death benefit is paid regardless of financial loss. The beneficiary receives the death benefit as agreed in the policy terms without needing to prove financial damage or hardship. However, subrogation answer choice C applies in property casualty insurance where the insurer seeks reimbursement from third parties. Missouri law treats life insurance differently, focusing on contractual payouts rather than strict indemnity. Question 20. Policy delivery methods and requirements. Which of the following is a responsibility of the insurance agent when delivering a term life insurance policy in Missouri? A. Ensuring that the policyholder signs a waiver of all riders. B. Confirming that the policyholder understands the policy terms and premium schedule. C. Recommending a new policy for each renewal. D. Collecting a commission based on the policyholder's health. Answer. B. Confirming that the policyholder understands the policy terms and premium schedule. Explanation. One of the key responsibilities of an insurance agent in Missouri is to ensure that the policyholder fully understands the terms of the policy, including the premium schedule, coverage amounts, and any applicable riders. This is part of the agent's fiduciary duty to act in the best interests of the client. Missouri's insurance regulations also require agents to provide accurate and clear information about the policy to prevent misunderstandings and potential disputes later. Question 21. Suicide clause in term life policies. What is the suicide clause in a Missouri term life insurance policy? A. It allows beneficiaries to receive double the death benefit if the policyholder dies by suicide. B. It denies payment of the death benefit if the insured dies by suicide within a specified period. C. It requires a special rider for suicide coverage. D. It provides an option for the insurer to pay only partial benefits in case of suicide. Answer. B. It denies payment of the death benefit if the insured dies by suicide within a specified period. Explanation. Most life insurance policies, including those in Missouri, include a suicide clause. This clause states that if the insured dies by suicide within a specific period, typically 2 years from the policy issue date, the insurer will not pay the death benefit. Instead, the insurer may return the premiums paid. After this period, the death benefit would be payable even if death is by suicide. This clause is designed to prevent individuals from purchasing policies with the intent of benefiting their beneficiaries through suicide shortly afterward. Question 22. Grace period for premium payments. Under Missouri law, how long is the grace period for paying overdue premiums on a term life insurance policy? A. 10 days. B. 15 days. C. 30 days. D. 60 days. Answer. C. 30 days. Explanation. Missouri law requires that term life insurance policies include a grace period of at least 30 days for the payment of overdue premiums. During this time, the policy remains in force and the insurer cannot cancel the policy for non-payment. This gives policyholders extra time to make a late payment without losing their coverage. If the insured dies during the grace period, the death benefit is still payable, although the overdue premium may be deducted from the benefit amount. Question 23. Term life insurance riders. Which rider allows the policyholder to purchase additional insurance coverage at specific intervals without providing evidence of insurability? A. Waiver of premium rider. B. Guaranteed insurability rider. C. Accelerated death benefit rider. D. Return of premium rider. Answer. B. Guaranteed insurability rider. Explanation. The guaranteed insurability rider allows the policyholder to purchase additional insurance coverage at certain intervals, such as at key life events, e.g., marriage, birth of a child, without having to undergo medical underwriting. This rider is particularly beneficial for individuals who anticipate changes in their insurance needs but want to secure future coverage without risking higher premiums due to changes in health. Missouri law mandates that insurers offering this rider clearly explain its terms and conditions to policyholders. Question 24. Group term life insurance. Which of the following is a primary feature of group term life insurance policies? A. They offer coverage only to individuals with pre-existing conditions. B. They provide coverage to a group of people under one master policy. C. They allow beneficiaries to choose the level of coverage. D. They have no expiration date. Answer. B. They provide coverage to a group of people under one master policy. Explanation. Group term life insurance provides coverage to multiple individuals, such as employees of a company or members of an organization, under a single master policy. Each individual receives a certificate of insurance, but the policy is owned by the organization or employer. Missouri law regulates the issuance of group life insurance to ensure that it is offered fairly and that individuals are informed of their coverage rights, including portability options when leaving the group. Question 25. Contestability period. What is the contestability period in a Missouri term life insurance policy? A. The period during which the insured can change the beneficiary. B. The period during which the insurer can contest or deny a claim based on misrepresentation. C. The period during which the insured can convert the policy to a whole life policy. D. The period during which premiums are waived if the insured becomes disabled. Answer. B. The period during which the insurer can contest or deny a claim based on misrepresentation. Explanation. The contestability period is a window of time, typically 2 years, from the policy's start date, during which the insurer can investigate and deny a claim if it finds evidence of material misrepresentation or fraud in the application. After this period, the policy becomes incontestable, meaning that the insurer cannot deny a claim based on misrepresentation except in cases of fraud. Missouri insurance regulations uphold this standard contestability period to protect both insurers and policyholders. Question 26. Free look period. How long is the free look period for life insurance policies in Missouri, allowing policyholders to review their policy and cancel without penalty? A. 5 days. B. 10 days. C. 20 days. D. 30 days. Answer. B. 10 days. Explanation. In Missouri, the free look period for life insurance policies is typically 10 days, although some insurers may offer longer periods. This period allows policyholders to review their policy and decide whether they want to keep it. If the policyholder decides to cancel within the free look period, they can return the policy and receive a full refund of any premiums paid with no penalties. This consumer protection measure ensures that individuals have the opportunity to make informed decisions about their insurance coverage. Question 27. Life insurance policy loans. Which of the following is true regarding loans against the cash value of a life insurance policy in Missouri? A. Policy loans are only available on term life insurance policies. B. Policyholders can borrow up to 50% of the death benefit. C. Interest is charged on the loan, but it does not have to be repaid. D. Unpaid loans reduce the death benefit payable to beneficiaries. Answer. D. Unpaid loans reduce the death benefit payable to beneficiaries. Explanation. Life insurance policies with cash value components, such as whole life policies, allow policyholders to take out loans against the accumulated cash value. If the loan is not repaid, the amount of the outstanding loan, including interest, is deducted from the death benefit when the insured dies. Term life insurance policies do not accumulate cash value and therefore do not offer loan provisions. Missouri regulations ensure that policyholders understand the impact of policy loans on their death benefit and overall policy value. Question 28. Misstatement of age or gender. If a policyholder's age or gender is misstated on a Missouri term life insurance policy, what will the insurer typically do when this is discovered? A. Cancel the policy immediately. B. Increase the death benefit to match the correct age or gender. C. Adjust the premiums or death benefit to reflect the correct age or gender. D. Deny any future claims. Answer. C. Adjust the premiums or death benefit to reflect the correct age or gender. Explanation. If an insurance company discovers that the age or gender of the policyholder was misstated on a life insurance application, the insurer will typically adjust the premiums or the death benefit to match what would have been issued at the correct age or gender. This adjustment ensures that the policy remains actuarially sound. Missouri law upholds this approach, allowing the insurer to correct the error without penalizing the policyholder beyond the necessary adjustments. Question 29. Irrevocable beneficiaries. Which of the following actions requires the consent of an irrevocable beneficiary in Missouri? A. Changing the premium payment schedule. B. Increasing the death benefit. C. Adding a new rider to the policy. D. Changing the beneficiary designation. Answer. D. Changing the beneficiary designation. Explanation. When an irrevocable beneficiary is named on a life insurance policy, the policyholder cannot change the beneficiary without the irrevocable beneficiary's written consent. This gives the beneficiary a level of security, ensuring that their interest in the policy cannot be removed or altered unilaterally. Missouri insurance law requires that the designation of an irrevocable beneficiary be explicitly documented and that the policyholder understands the legal implications of such a designation. Question 30. Replacement of life insurance policies in Missouri. What is required when replacing an existing life insurance policy with a new one? A. The new insurer must notify the old insurer. B. The policyholder must prove insurability again. C. The agent must provide a comparison of the old and new policies. D. The policyholder must pay double premiums for 1 year. Answer: C. The agent must provide a comparison of the old and new policies. Explanation: when replacing an existing life insurance policy with a new one, Missouri law requires that the agent provide a detailed comparison of the old and new policies to ensure that the policyholder understands the differences. This includes any changes in coverage, premiums, benefits, and potential surrender charges. The comparison helps the policyholder make an informed decision about whether the replacement is in their best interest. The new insurer may also need to notify the old insurer, but the comparison is the key requirement.